So having looked a little bit at the supply of money and got a initial sense of how the Federal Reserve can intervene in markets and control money supply and so on, let's go ahead and take a look at the demand for money. Now, it's interesting to ask yourself, why do people demand money? Remember, I don't mean why do people need income or why do people need a way to sort of buy things. I'm asking, why do you demand money? Why do I hold a certain volume of money in my checking account, in my pocket, and so on? Right? Because in fact, when I hold money, I'm not lending it out, I'm not earning an interest, all kinds of things that I'm not doing with it. So the question is an interesting one because money is a stock, not a flow. And so what we are going to have to think about is, what are the reasons people hold money? And so first and foremost, for transactions. So for example, usually I don't hang on to a ton of money if I only have transactions every so often, right? So I can put things in my savings account around the first of the month. Once my paycheck comes in, my holdings go down, and then over time I make my payments, I move stuff to saving, goes, right? So at different points in time, I have different level of stocks of money, and a lot of how much I keep there kind of depends on exactly how often I have to make payments and how large those payments are, right? So there is certain transaction demand for money, just something that people hold in order to make transactions. Transactions demand for money. The second is sometimes called the precautionary. Demand for money. And this is basically that I usually hold a little bit more than I need in my checking account. And I do that basically because it's a precaution. I'm a cautious kind of person. I don't want to be caught short if there's an emergency. I don't want to end up suddenly needing to be able to catch a flight somewhere at the last minute and not have enough on hand, right? So it's a precautionary demand for money. And then the most common is that in addition to transactions demand and precautionary demand, people actually hold money as part of an asset portfolio, drawing both on liquidity preference and expectations. So let me explain this one, because this is actually one of the biggest sources of money demand. So to understand how money functions in an asset portfolio, let's remind ourselves that money is just one of the many ways in which you can hold your wealth, right? So I've got my wealth. I can hold some of it in my checking account. I can put some of it into a Roth IRA. I can take some of it and invest it in real estate. I can take some of it and hold assets that are in the forms of stocks and bonds and so on, right? So essentially there is an array of assets, and at this point when I'm using the word stock as asset, I mean a very particular kind of asset. So difference between stocks and bonds. Bonds are essentially a promise to pay someone an interest at a given time in the future, or the value of sort of whatever bond issue it is. Stocks are a promise to pay someone contingent dividends or profit share and so on, because you're getting a piece of a business in exchange for accepting the risks of the business. You then get also to get a share in the profits of the business. So what you really have to remember is, whether it's stocks, whether it's bonds, whatever form the asset takes, it's not actually an investment in that macro sense of the word, which is that I create growth. It's possible that this will enable growth if whoever issued the stock or bond took that money that they borrowed from you, took that borrowing, and then did the macro kind of investment where they actually built physical plants and created future growth and so on. But what I'm doing when I engage in purchases of stocks and bonds is that I am part of a system of borrowing and lending. And when I lend, I'm essentially engaging in an action where I think that in exchange for turning over the use of a portion of my resources today, I will get a share or a cut of whatever income gets generated tomorrow or day after when you pay me. So of course a lot depends on whether you can actually pay me, right? I might borrow money from someone and go off and say, I've got a system to really make you rich, go off to Vegas and gamble, and hey, I may not make that much money. They've lost their, So how good this promise is really actually depends on whether the growth pans out. That's why in macro we really insist, don't call it investment just because you lent the money. It's only investment if there is an actual fixed capital acquisition that is going to create future growth. Otherwise, all that's happening is a redistribution. I'm borrowing, you're lending, stuff like that. All right? But let's take a look at wealth, because wealth turns out to be a kind of important way in which people make decisions. So when I look at a stock or a bond, if I essentially start by just looking at a bond, if I'm lending money, most of you have come across the formula for compound interest, right? Which is that the value in, say, 5 years, if I lent out certain amount of money or principal, $100, whatever it is, today, right? The value of it 5 years from now would be the principal plus the interest compounded over 2 years, all right? So what happens is that if I give principal of so much today, it must be because at this going interest rate, I expect that I will get more tomorrow. So I can flip this around, because when I buy a stock or a bond, essentially what I'm doing is I'm putting forward money now. So I'm putting forward the equivalent of a principal. A stock or a bond is simply what it says on the share certificate or on the bond, that this is what you will get paid, this is what its cash value is, and so on. So now here's the thing. So I went ahead and bought a bond, and I expect that 5 years from now, let's say I bought something for, I bought it for $100, right? And it says that in 5 years' time, you'll get $110. That's what it says. Right? $10, 5 years' time, 100 becomes 110. I decide I can't wait 5 years. I need to get out of this because, my mommy is ill, or because I want to buy, to put a down payment for something, whatever. So I can come to you and I can say, hey, here it is. Here, I've got this. I bought this for $100. It's going to give me 110 5 years from now. Why don't you take it? You're going to look at it and say, hey, all right, I may give you 100 for it if the interest rate is unchanged. But what if in the interim the interest rate went up? If the interest rate went up, you would look at me and say, why should I give you $100 to get 110 in 5 years' time? If I put $100 today with a higher interest rate, I can get $114 in 5 years' time. Why should I do that? I'll give you less than 100. So do you see what happened is when the interest rate started going up, the present value of my stock or bond, what you call the price of the bond, started going down, right? Because I would much rather, because I need that spread to reflect what the going rate of interest is. So one of the things that emerges from this is that because this is usually given, because this is usually just the promise that the firm makes that this is what you will get paid XX time, blah, 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 blah. The key is that the price becomes inversely related. The price, which is the principal that I'm putting forward today, becomes inversely related to the interest rate. If interest rates start going up, my existing stocks and bonds start losing value. If interest rates start going down, so I have this bond, I paid $100 for it, it's going to promise to pay you $110 in 5 years. If the interest rates start going down, people around me are going to say, hey, 110, not a bad deal. With the going interest rate, I could only get 104. Why don't I get it from you? I'll pay you more than $100. Right? So part of what's happening is the inverse relation between the interest rate and the price of bonds. So that's the first thing we want to keep in mind. Here's the second thing. In addition to this, because of the emergence of stock and bond markets, expectations start playing a pretty large role in how stock and bond markets work. So here it is. I paid $100 for a bond that promises to pay me $110 in 5 years' time, right? I think the interest rate is going to go down, which means I know if that works out, I think the price of my bond is going to go down. If I think the price of my bond is going to go down, I'm going to sell now, because otherwise my wealth will diminish. Conversely, if I think the interest rate is going to go up and the price of bond is going to go down, I might actually do even more things. I might do things like, it's called selling short, it's called, futures markets. I might essentially tell people, hey, I'll go ahead and sell you this, buy the stock from you, and then I might arbitrage against today's prices. Conversely, if I thought the interest rate was going to go down, it means that I think the price of stocks and bonds is going to go up. So I might buy now. But when I buy now, it can become a self-fulfilling prophecy, because the more I buy, the more the price will go up. So these kinds of speculative bubbles can really start shaping stock and bond markets. And this is something we pay more attention to if you come to upper division classes, say on money and banking or on international political economy. But just keep in mind that one of the reasons the Fed exists and one of the things the Fed tries to do is to kind of manage some of this and to do it in a way where people are not speculating, do you think the Fed's going to increase the interest rate? Do you think the Fed's going to decrease the interest rate? Do you think the price is going to go up? Do you think the price is going to go down? Right? So that's kind of the context within which the Fed is operating. But what this means is essentially, if I look at the demand for money, expectations about the future, do I think there's going to be a recession? Do I think interest rates are going to fall? Do I think prices are going to go up? Also start to play a kind of role in all this. And if people get really nervous about the future, the chances are they will pull out of stock and bond markets altogether and move into money, right? So you've got transactions demand for money, you've got precautionary demand for money, and you've got speculative demands for money, where people hang on to money just because it's an asset they feel is safer than other assets. So with that in mind, and with the realization that there is an inverse relationship between price of stocks and bonds and interest rates, what we begin to realize is that the demand for money depends on the interest rate, among other reasons, because the demand for money depends on people moving in and out of stocks and bonds. Moving out of stocks and bonds is the same thing as moving into money, because that's what it means, right? It's like getting rid of stocks and bonds, hanging on to cash. Moving out of money is the same thing as taking that and putting it in stocks and bonds instead. Right? The final piece is that interest rates are obviously not a single thing, but there is a term structure to the interest rates. There's short-term rates, where for very short-term borrowing and lending, and that's one set of rates. And then there's medium-term rates, there's long-term rates, there's also literally overnight discount markets. There's a whole bunch of them. The text goes through them. But essentially, the idea is that the interest rates will vary depending on how much time your finance will be tied up in something. So short-term rates tend to be lower, usually longer-term rates are higher, and depending on the riskiness of whatever stock or bond you're looking at, because, you know, you're looking at higher risk, higher return, lower risk, safer, lower return. So with that in mind, let's take a look at how interest rates get set in money markets.